Hello and welcome to the SIA Wealth Management March 2023 Market Outlook webinar. My name is Colin Cieszynski, Chief Market Strategist with SIA Wealth, and I'll be hosting and presenting today. We're going to look today at continue our theme from last month with market insights for the moving forward. The last month has been quite volatile and tumultuous. The New Year's rally that kicked off 2023 pretty much seems to have come to an end. And so the question now that a lot of us investors are facing is, has the last few weeks been a correction within a bull market or the start of a new bear market down leg? And we've seen a lot of concerns ramp up. First, we saw inflation and rising interest rates become a concern. And then all of a sudden, some of that is kind of flipped with growing concerns about the banking sector. And not just, it started with cryptocurrency banks and then regional banks. And now it's expanded out into more larger US and global banks. And so this is a growing problem. And how does the governments and central banks respond to this challenge could still have a potential impact on asset flows and capital flows and sentiment in the markets. So there's a couple of ways of looking at this. And first, I'll preface to note that all of the charts in this presentation are as of the close on Monday, March the 13th. We recognize that markets have continued to change and move since then, but there had to be a cutoff point, and that's what we've used. So just to note that, we will note in our comments where applicable some of the more recent changes that have happened. So first, thinking about the bearish case, one could think that, well, okay, the recent run in US banks and weakness in commodities suggests that there's a fragile state now for the world economy and the banking system, and that things could potentially crumble and things could get worse. On the other hand, the bullish case would be that to date, problems at banks have been relatively contained, and this whole notion that of the Fed up until last week of having to continue raising interest rates, well, that might have to stop in the short term, and there's implications for that, but that may end up being a problem that gets kicked down the road. The bottom line of all of this is we're continuing to see a lot of uncertainty. There's a lot of volatility, and we're seeing black swan events show up out of nowhere, and we're seeing sometimes the whole investment thesis situation flipping on a dime like we've seen over the last week. And because of that, it reinforces the need for a rules-based tactical approach to investing. Investors can't afford to sit and be complacent and get buffered and battered by all of the different crosswinds out there. People need to be ready and have a disciplined approach for how to invest, when to take advantage of opportunities, when to manage risk, and where to focus capital. So first, I'm going to talk about what I call the bearish volatile case for markets. Really, it's essentially, we're seeing a definite increase in volatility over the last few weeks, and some days it's been bullish and some days it's been bearish. But overall, the one thing that does seem to have become more clear is that we're into a period of increasing volatility. So we'll look at things like monetary policy, banking, China, and capital flows among markets. So first of all, March has come in like a lion. This is our long-term seasonality chart, and so the blue lines are the long-term average 1987 to 2022. The red bars are 2022, and the green bars are 2013. I note the March bar went to Monday, March the 13th, and so what we've seen here is that January, we had a very strong month, relative, certainly a much better January this year than last year, and well above historical averages. That, however, got erased in February, which actually, February 23 actually ended up being worse. This is for the Dow, worse for the Dow than February of 2022. March, actually in 22 had been a rebound month, but this year we're not seeing it. We've seen so far, March has come in like a lion, and markets have continued to decline. One of the key events coming up that's actually scheduled. I've mentioned things have just been coming in fast and furious from all directions, but the key thing we're watching for now, and a lot of investors are, is what happens with the next Fed decision and their forecasts. It's March 22nd, 2023, 2 p.m. Eastern time, followed by Fed Chair Powell's press conference at 2:30 p.m. Eastern time. So this is not only an interest rate decision, it's also their forecast for Fed funds, also known as the dot plot, for GDP, for inflation, for employment. Really important. And as we say, I highlight, there's been a lot of articles like this, but this one from Bloomberg, this headline seemed to pretty much sum it up. Fed battle plan for inflation shredded by financial turmoil. Up until a week ago, Wednesday the 8th, the Fed Chair Powell was out saying inflation is high and we're going to raise rates and we may even accelerate the pace of rate hikes again. Well, that's quickly changed over the last week with the growing crisis in the banking sector. All of a sudden, well, maybe the Fed might not be able to raise rates, and in fact, they may have to at least pause and take steps to shore up confidence in the banking system. That's a huge change in a small number of days. So, what we're watching for now, does the Fed go? What does the Fed do? If they raise rates by 0.5%, then that suggests they're still concerned about inflation. If they raise rates by 0.25%, well, that's pretty much what they did last time and has been expected. And if they don't raise rates at all, that could raise another concern, because people might start to say, well, why is the Fed not raising rates when inflation is still increasing? Does that mean there's trouble in the economy? What does that mean about the banking system? So there's a number of ways that this could be read. And the other one will be, of course, the dot plot as to what happens to their forecast for interest rates at the end of this year. Do they move their forecasts up to a higher interest rate, keep them the same, turn it down, and that could have implications both bullish and bearish for the markets. Overall, up until last week, the general trend towards global monetary tightening has continued. In the last few weeks, we've seen the Bank of Canada actually did pause, as they had hinted that they would. The Reserve Bank of Australia continued to play catch up, as they had indicated, and the RBA actually suggested that they may pause raising rate hikes at their next meeting in April. So keeping an eye out for that. And meanwhile, the Fed was talking hawkish, but things may change given the events of the last few days. Overall, the progress on inflation of late has been mixed. We have seen that since interest rates have started to climb, inflation has started to come down. In the last few weeks, the declines in inflation were not as fast as people had hoped. And in particular, if we look at the gray line, average hourly earnings actually went up. That was an indication of that wage pressures still remain intact. We've also though seen the core PCE inflation that the Fed uses in CPI, which is the more broad measure, continue to decline, as has producer prices as well in the States. We don't include that on this chart because it's more volatile, but producer price inflation has also continued to come down. One of the things that's really had been impacting the market up until a week ago was the rapid rise in the U.S. Treasury note yield. We'd seen that, particularly if we look over on the right-hand side of this chart, the 10-year note yield TNX had peaked just above 4% back in September, October, and then it started to come back down. And as it was coming back down, we had that nice fall rally and New Year's rally in the markets. But after finding support about 3.5%, it bounced in recent weeks back up closer to 4%, and that started the correction we'd seen unfold. And then that's now accelerated because of outside factors not related to rates. But basically, what we're seeing here is the 10-year U.S. Treasury note yield is bouncing around between about 3.4% support and 4.0% resistance. Whichever way it ends up breaking out of this range could have quite a significant impact on market sentiment, whether that means central banks are tightening or central banks are easing, and more importantly, why are they doing that, could also be important. And I show this because the 10-year Treasury note yield versus U.S. indices and bonds, we can see there's been quite an inverse relationship between the two going back to over the last year. During periods where we've seen U.S. Treasury yields climbing, we've seen stocks and bonds falling. That's the purple line is the S&P 500, and the orange line is the TLT major, one of the most active 20-year plus Treasury bond ETFs. So, but what's interesting with this also, if we note, is that the declines in the market started with interest rates rising. Now we have actually seen the TNX start to come down, and bonds had started to pick up, but equities have not, and that's because we've seen there's been concern about equities, particularly concerns about banks that have been dragging on indices. And this is my be careful what you wish for slide. And it's interest rate peaks and market troughs. And we seem to be kind of running into this a bit now. Has been over the last year, has been a focus on interest rates. And when, as I said, when rates have rising, markets have been going down. And when traded rates were coming down, stocks indices were going up. But what we have to be careful with is that at some point historically, when the Fed has started to stop raising rates and either pause or cut rates, we've seen continued declines in the markets, because often the case is that's often associated with a weakening economy. And we've seen that in the last week, that all of a sudden the speculation on the Fed raising rates has stopped because the underlying stock market thesis for investing has weakened, particularly the problems in the banking sector, and that has dragged on stocks. So historically, over the last 50 years, the Fed has generally stopped raising interest rates after Fed funds rate has climbed above CPI, and then it's gone down from there. But we've looked at this in terms of peaks and troughs, and what's happened after the Fed funds have peaked. Well, the Fed funds peaked in June 2000. The Fed funds peaked in June 2000, the stock market peaked in December 1999, and the market didn't bottom out till September of 2002, falling 27.3% after Fed funds peaked. The Fed funds peaked in June 2007, the market bottomed out in March of 2009, 50% decline for the Dow Jones Industrial Average after Fed funds peaked. Even the most recent cycle, Fed funds peaked in April of 2019, and yes, they did actually get back above CPI at that point in time. The market bottomed out in March of 2020, a 23% decline. Obviously, that was quite a sharp decline in the markets, and that was impacted by the COVID crisis. And so it's a little bit different. Obviously, that one played out much faster than previous cycles, but still the notion that markets went down after the Fed stopped raising rates was remained intact. Another thing that's put headwinds in front of a lot of markets has been a rally in the US dollar, as US interest rates were climbing relative to other countries, and in some cases, then we've seen a big rally for the US dollar. So year to date, up to March the 7th, we can see a broad-based US dollar up against pretty much every currency in the world, interestingly, except the Mexican peso. Mexican peso has done extremely well. Since then, in the last March 7th to 13th, we had a bit more of a mixed performance in the US. Treasury yields started to come down, and we saw the US dollar come off. Interestingly enough, it rebounded against the Mexican peso the most, but everything else, it was a little bit more of a mixed performance. Now, in the last couple of days, we've seen the US start to rally again, as some of the concerns about the banking sector have shifted to Europe, particularly with Credit Suisse running into problems, and that has started to drag on the Swiss franc, the euro, and the pound relative to the US dollar. So we're keeping an eye on that as we continue to move through the week. Here's the US dollar having an impact on the S&P 500 index and gold. And we've noted here that this is the same kind of inverse relationship where as the US dollar has been rising, generally speaking, the S&P 500 has been falling, and the price of gold. Gold and the US dollar are each other's natural enemy. They're nemesis of each other. The US dollar being the world's premier paper currency, gold being the world's premier hard currency. They often over time tend to move in opposite directions of each other, so that's not unusual. So I've talked a lot about banking and about monetary policy and interest rates and inflation, but there's another story as well, and that was the other piece of that drove the New Year's rally was speculation that China's economy would recover and could recover quickly. given that they finally dropped their zero COVID policy. They finally ended the lockdowns that crushed their economy and stock markets in the second half of 2022. And that had helped, especially, particularly with international markets and with commodities. Now, what's happened over the last few weeks is this has kind of faded. And earlier this month, the Chinese government came out and said, okay, they think that they can grow GDP 5% this year. Well, it sounds good, and it's certainly better than the 3% it ended up growing in 2022. However, it's still slower than their original forecast of 5.5% for 2022. So the market got the sense that their recovery could be more sluggish than originally had been hoped. This has started to weigh on the Hang Seng, which is the orange line, and also dragging on copper. Copper is particularly sensitive to the global economy, to Chinese resource demand. And so as this story has faded, we have seen copper starting to come back down. Interestingly enough, crude oil has not. Crude oil has been trading sideways. It sometimes is influenced by China, but crude oil had actually sold off in November and has been just kind of trending sideways since then. Now here we've seen the regional bank problems, which has now become the global bank problems, impacting risk appetite. If we look at, there's a regional bank ETF, IAT, that's the orange line, we can see started to come off in early February and then just dropped off a cliff in the last week or so. Now we've seen recently as well that that is impacted and seen capital is starting to come out of what we call risk markets. So we've seen some choppiness in cryptocurrencies. In emerging markets, as the blue line has generally been trending downwards since January. It hasn't dropped off quite as fast since it's more international and more resource focused than banking focused, but still we have seen capital coming out of emerging markets, and we have seen capital coming out of the Russell 2000, which is the black line and the black arrows, has also started to accelerate downward recently. On the flip side of that, we have seen the flight underway to what we call historic havens of safety. So gold, the Japanese yen in particular, have really started to take off. Again, this is the regional banks, is the orange line, plunging over the last few days, and we've seen, what have we seen rallying? Well, gold is the blue line, the Japanese yen is the purple line, and silver is the black line. And what's most interesting about the yen here is that the yen historically has been a haven for capital in times of trouble, along with gold. But that relationship decoupled last year. The yen just kept on going down when the Bank of Japan remained dovish relative to all the other central banks. It got left in the dust and the yen crashed. But this year now we're seeing for the first time that the yen has actually started to come back and reassert its role as a haven for capital as well, alongside gold. And that's just something that's just emerged in the last week or so. So it seems like there's certainly been a lot of negative news and market outlook and market action recently. So, however, we will outline some of the things that there's of the bullish case for markets, and really what this has come down to at the current point in time is a couple of things. The biggest one being that so far, equity markets seem to be bending but not breaking. We do have a correction, but we haven't seen significant breakdowns as of yet. But we are keeping an eye on it. But so far, it still feels more like a correction than an outright downturn. Now, this may change over the next few days, and this could even change between now and the Fed meeting next week. But on the interim, at least, this is kind of where we're at. And we'll note some of the levels that are of significance as well. So first of all, we're still in the third year of the presidential cycle, which historically has been a positive year for markets. We've talked in previous presentations about the golden cross and the S&P 500 and the head and shoulders base. So far, as long as the S&P remains above 3750, it's above the right shoulder, although it has dropped back under its moving averages. The golden cross has not reversed, but the price has come back under the 50 and 200-day averages. If it breaks 3750, would be ominous, and if the S&P 500 were to break below 3500, would be a signal of a new down leg. On the flip side, about 4100 has been the recent resistance for the S&P 500, 4000 to 4100, give or take a little bit. So if we start seeing it turning upwards and powering up through there, that would be encouraging and a bullish sign. Going back to Dow theory, we're finding the Dow indices are kind of turning down and confirming each other, but again, they haven't broken down to new lows. So we have the Dow Industrials here have rolled down. They are on a bearish double bottom signal, but they're also still well above their October lows. Looking at the transports, we're seeing is in a correction, a high pull warning, not a fully decisive breakdown. It does remain in an upward trend, and it does remain above its January lows. The utility sector is an interest rate sensitive sector, so it's been getting hammered recently based on the concerns that the Fed would continue to raise interest rates. However, if that changes and either we see continued stress in the markets or we see continued a change in attitudes towards interest rate hikes, this could change because utilities are not just an interest rate sensitive sector, they're also historically a defensive sector. So if we see attitudes change where people think that rates may stop going up or start going down and people get more defensive, then utilities is a sector that potentially could attract renewed interest. So we do still keep an eye on this group as well. The Russell 2000 small cap index, we note has, as I mentioned earlier, being more of a risk market, being more of small cap plays, we have seen the Russell basically has given back all of its gains that started from back in December. However, it hasn't gone any lower yet, but we are keeping an eye on that. Key supports are around 1730 and around 1660 for noting for what's up with the Russell. We also wanted to note here that there's been we look at sectors, and sectors give us an idea of where people are feeling, where capital is going, where money is moving within equity markets, because money doesn't all move between asset classes. Sometimes it moves within asset classes as well, and there's opportunities there. So first of all, so from December 31st to the 13th of February, we saw February, so that's a month ago. We had a year-to-date consumer discretionary, information technology, industrials, communications, financials, real estate. We're all doing really, really well. Utilities were lagging, and but overall, all major industry sectors were green. Now, if we look at the last month, things have reversed quite dramatically. Some of the interest-sensitive groups, financials, real estate, along with energy, materials, consumer discretionary, communications, all took quite a hit in the last month. Sectors that fell the least, interestingly enough, utilities, as I mentioned, is historically defensive, along with healthcare and consumer staples. Those defensive groups fell less than others, along with industrials as well. And if we look at the year-to-date performance now, up to March 13th, we can see it's kind of mixed. Financials are down, energy is down, utilities are still down, but otherwise, we do see some sectors that are up. Industrials are actually up. We're up year to date up till Monday, as well as information technology and consumer discretionary. So we are starting to see some sifting and sorting and changes in relative performance between industry groups, even though we're getting these larger swings up and down. But if we look overall, though, as these play out, we are seeing some significant differences in performance starting to emerge. So the bottom line of all of this is the tactical approach to investing remains important and really critical for investors. At this point in time, the equity SIA charts equity action call remains in the green favored zone. It's a macro measure of global equity market risk, money flows, and overall price action changes. And so this measures the relative performance of equities relative to other asset classes, being commodities, cash, and bonds. And so in the last month, although equities went down, bonds had continued to struggle with interest rates rising, and commodities have been, in particular, have been struggling as well. We continue to note on that as market conditions have changed between 2021 and 2023, SIA Wealth has, in this case, we're using the BMO Tactical Global Equity ETF Fund, which SIA Wealth Management is a sub-advisor on, and basically we can see that between January of 2021 and now, the equity weighting has varied between 100% equity and 0% equity, and we've moved upwards, and that has moved downwards as equity market conditions have changed and evolved, and that remains the case and may continue to change moving forward into the future. In addition to the broader equity markets, in terms of how much capital is deployed within equity markets, I also note that that SIA Wealth does continue to rotate specific holdings as well, and with that, sector weightings do change and evolve over time as well, looking to take advantage of opportunities and manage risks as they present themselves. I did want to add one more bonus comment as well to today's presentation, which is something that didn't quite fit in anywhere else, but I did want to highlight it. I talked a little bit about the crude oil price earlier in this presentation being flat, and in previous webinars we have talked about the oil price versus oil and gas stocks, and this time I thought I would just expand it out a little bit. So the gray line is the crude oil price, which you can see has been flat lately. The orange line is the exploration and production US ETF IEO. We've added the blue line IEZ, which is the equipment and services US ETF, and at the bottom we've included TAN, which is the solar ETF for the alternative energy, since that tends to get a lot of attention in the media and the general public consciousness. So a couple of things from this: the recent action in energy producers and energy services is that they have started to come down faster than the oil price. For a long time, we've had this debate of how this gap that had opened up between the oil and oil stocks, and how would that get closed? Would that be stocks pull up the oil price, or the oil price drags down the stock price as well? It seems that with equity markets coming back, selling off, that it appears as though energy stocks are coming down towards the energy price, because they of late have been falling faster than the commodity price. The other interesting thing to note here is just that, in fact, if we look back to the beginning of January of 2022, alternative energy stocks have basically been flat. They've gone up, they've gone down, but their overall trend has been sideways for well over a year now. As I mentioned, SIA Wealth Management is a sub-advisor for a number of funds that are distributed by BMO Global Asset Management. So these are their codes here. We have 2 of which trade as exchange-traded funds, and 5 of which are available as mutual funds. And finally, this is our disclaimer. And at this point, that concludes my prepared remarks. And thank you all very much for joining us today. And we look forward to speaking with you again next month.